Welcome to episode 7 of AltFinance, the funding frontier. I'm your host, Jason Feimster, the founder and CEO of Moonshine Capital. Today, we're diving into a critical yet often overlooked aspect of business finance, corporate credit. This isn't just a number or a score, it's a gateway to growth and expansion. In this episode, we'll unravel the mysteries of corporate credit and how it can be a powerhouse for your business's growth. We'll look at what corporate credit is, how to build and manage it effectively, and hear real-life stories of businesses that harnessed its potential to reach new heights. So let's set the sail on this journey to unlock the untapped resource of corporate credit. Let's begin our journey by understanding what exactly corporate credit is. Imagine corporate credit as a report card for your business, reflecting its financial responsibility and creditworthiness. Unlike personal credit, which is tied to an individual's financial history, corporate credit is all about your business's financial track record. It's what lenders, suppliers, and even potential business partners look at when they're deciding whether to do business with you. The essence of corporate credit lies in its ability to separate your personal finances from your business dealings. This separation is crucial for protecting personal assets and establishing credibility in the business world. It's not just about getting loans, it's about creating a trustworthy persona for your company in the eyes of everyone you do business with. But why is corporate credit so vital for businesses, especially small and medium sized enterprises? To put it simply, it opens doors. A strong corporate credit score can lead to better terms with suppliers, lower rates on loans, and even the ability to secure larger amounts of financing. This can be a game changer for businesses looking to expand, invest in new equipment, or even weather financial storms. Take, for instance, a real world example. According to a study by the National Small Business Association, nearly 1 in 5 small businesses reported that their ability to obtain financing improved in 2021 compared to the previous year. This improvement was partly due to better corporate credit profiles, enabling these businesses to access more funding options and grow their operations. So, as we delve deeper into today's topic, remember this: corporate credit is not just a number, it's a reflection of your business's financial health and a key player in your growth strategy. Now that we've established what corporate credit is and its importance, let's talk about building and managing it. This is especially crucial for new businesses or those that haven't yet established a corporate credit history. The journey of building corporate credit is like constructing a skyscraper. It takes time, planning, and careful execution. First, let's look at the initial steps to build corporate credit. It begins with setting up your business properly. This means incorporating your business or forming an LLC, obtaining a federal EIN, and opening a business bank account. These steps are foundational. They distinguish your personal finances from your business operations, a critical aspect of corporate credit. Next, you need to establish credit lines with vendors and suppliers who report to the major business credit bureaus like Duns& Bradstreet, Experian Business, and Equifax Business. This is like laying the bricks of your skyscraper. You start small, perhaps with a business credit card or a line of credit from a supplier, and then you build up from there. Now, managing corporate credit effectively is where many businesses stumble. It's not just about having credit, it's about how you use it. This means paying your bills on time, keeping your debt levels manageable, and monitoring your credit reports regularly for errors and fraudulent activity. But here's where it gets tricky. Unlike personal credit, where late payments aren't reported until they're at least 30 days overdue, some business credit reports can reflect late payments as soon as they're past the due date. This can have a significant impact on your corporate credit score. To give you an example, let's take the case of a small business in the manufacturing sector. According to a report by the Federal Reserve, nearly 63% of small businesses in the manufacturing industry sought external funding in 2019. The businesses with strong corporate credit were able to secure better terms and lower interest rates, directly impacting their bottom line and growth potential. In summary, building and managing corporate credit is a continual process. It's about making strategic financial decisions and understanding the impact of those decisions on your business's creditworthiness. Having laid the groundwork on building and managing corporate credit, let's explore its tangible impact on business growth. This is where the theoretical meets the practical, where numbers on a page translate into real world business opportunities. Corporate credit is often the fuel that powers the engine of growth for many businesses. It's not just about getting access to funds, it's about what you do with those funds. Investment in new technologies, expansion into new markets, hiring key staff, or even smoothing out cash flow during lean periods. These are just a few examples of how businesses can use credit as a catalyst for growth. Let's delve into some concrete examples. A notable case is that of a mid-sized tech company that leveraged its strong corporate credit to secure a substantial line of credit. This funding allowed them to invest heavily in research and development, resulting in groundbreaking new products. The result? A significant increase in market share and revenue. Another example comes from the retail sector. A small but growing retail chain used its corporate credit to negotiate better terms with suppliers, allowing for more inventory, flexibility, and the ability to capitalize on market trends quickly. This agility gave them a competitive advantage, leading to increased sales and expansion into new locations. These examples underscore a crucial point. Corporate credit is more than a financial tool, it's a strategic asset. It opens up possibilities that might otherwise be out of reach for businesses, especially in highly competitive industries. But the impact of corporate credit isn't just felt in the realms of financing and operations. It also plays a pivotal role in shaping a business's reputation. A strong credit profile can enhance a company's standing in the eyes of customers, partners, and investors. It signals stability, reliability, and a solid track record, all key attributes in the business world. In summary, the impact of corporate credit on business growth is multifaceted. It's about unlocking potential, seizing opportunities, and positioning your business for success in today's fast paced economic environment. Moving forward, let's consider corporate credit not just as a necessity, but as a strategic tool in your financial arsenal. When wielded wisely, it can provide significant advantages and opportunities for your business. To begin with, corporate credit offers the flexibility to maneuver through various business scenarios. Whether it's taking advantage of a sudden market opportunity or weathering an unforeseen financial storm, having access to credit can make all the difference. It's about having the financial agility to respond to changing circumstances quickly and effectively. But how do you leverage corporate credit strategically? It starts with understanding the various credit instruments available and how they align with your business's goals. For instance, a revolving line of credit might be ideal for businesses that need flexible working capital, while long term loans could be more suitable for major investments like purchasing new equipment or expanding facilities. Consider the story of a manufacturing company that used a combination of short term trade credit and long term loans to revamp its production line with state of the art equipment. This strategic move not only increased their production capacity, but also improved efficiency, leading to a significant boost in their market competitiveness. Another aspect of using corporate credit strategically involves managing risk. It's about balancing the benefits of borrowing against the potential liabilities. This means having a clear understanding of your business's financial health, the terms of the credit, and the overall market conditions. Effective risk management and credit usage is a hallmark of savvy financial leadership. Let's also talk about the impact of corporate credit on business relationships. A strong credit profile can enhance your bargaining power with suppliers, allowing you to negotiate better terms. It can also be a deciding factor in securing lucrative contracts, especially when counterparties access your financial stability. In conclusion, corporate credit, when managed strategically, can be a powerful tool for driving business growth. It's about making informed decisions, understanding the nuances of various credit products, and aligning them with your overall business strategy. In the next segment, we will explore the challenges and solutions in the realm of corporate credit. In this segment, we're going to navigate through the challenges businesses often face in the realm of corporate credit and explore practical solutions to overcome them. Like any financial tool, corporate credit comes with its own set of obstacles, but with the right approach, these challenges can be transformed into opportunities. One common challenge is the initial establishment of corporate credit, especially for startups and small businesses. Without an established credit history, securing credit lines can be a steep hill to climb. The solution here lies in starting small and being strategic. Businesses can begin by establishing credit with smaller, local suppliers or vendors who are more flexible and may not require an extensive credit history. Another approach is using secured business credit cards, where a deposit serves as collateral. Another challenge is maintaining and improving a corporate credit score. It's a dynamic process influenced by various factors such as payment history, debt utilization, and the age of credit accounts. To manage this effectively, businesses need to ensure timely payments, keep their credit utilization low, and avoid applying for too much credit at once. Regular monitoring of your credit report is also key, as it allows you to spot and address any errors or inconsistencies promptly. Let's talk about real life scenario. A construction company faced significant challenges in securing large project financing due to a mediocre credit score. By implementing a structured plan to improve their credit management, including negotiating better payment terms with suppliers and reducing their credit utilization, they were able to improve their credit score significantly. This improvement opened the door to better financing options, allowing them to bid on larger projects. There's also the challenge of navigating the complex landscape of corporate credit. The market offers a plethora of credit products, each with its own terms, conditions, and implications. Businesses need to be well informed and perhaps seek advice from financial experts to understand which products best suit their specific needs and circumstances. Finally, let's consider the impact of economic fluctuations on corporate credit. In times of economic downturn, maintaining a strong credit profile becomes even more challenging. Businesses need to be proactive in managing their finances, possibly restructuring their debts, and maintaining open communication with creditors to navigate through tough times. In summary, while the challenges in managing corporate credit can be daunting, they are not insurmountable. With proactive approach, strategic planning, and effective management, these challenges can be turned into stepping stones for business growth and success. As we approach the conclusion of our exploration into corporate credit, let's cast our gaze forward and ponder the future of this crucial financial element. Understanding emerging trends and future predictions is essential for any business looking to stay ahead in the ever evolving financial landscape. The future of corporate credit is being shaped by several key factors, including technological advancements, regulatory changes, and shifting economic conditions. One of the most significant trends we're seeing is the increasing use of financial technology, or fintech, in the credit industry. Fintech solutions are making it easier, faster, and often cheaper to access corporate credit. They're using algorithms and artificial intelligence to assess creditworthiness, reducing the reliance on traditional credit scoring methods. This shift could open up new opportunities for businesses that have previously struggled to secure credit through conventional means. Another trend to watch is the changing regulatory environment. Governments and financial institutions worldwide are reevaluating their lending policies and regulations, partly in response to the economic challenges and also due to the rise of alternative lending platforms. These changes could lead to more stringent lending criteria or, conversely, create new avenues for businesses to access credit. Let's not forget the impact of global economic trends. Factors such as fluctuating interest rates, international trade policies, and economic cycles play a significant role in the availability and terms of corporate credit. For instance, in a low interest rate environment, businesses might find it more feasible to secure affordable credit, while in times of economic uncertainty, lenders might become more cautious. A fascinating development in the realm of corporate credit is the growing focus on sustainability and social responsibility. We're beginning to see credit products that are tied to a company's environmental, social, and governance or ESG performance. This shift reflects a broader change in the business world, where financial performance is increasingly linked with social and environmental impact. In conclusion, the future of corporate credit is dynamic and multifaceted. Businesses need to stay informed about these trends and adapt their strategies accordingly. Whether it's embracing new technologies, navigating regulatory changes, or aligning with global economic shifts, staying ahead in the corporate credit game will be key to securing financial health and achieving long term growth. As we draw this episode to a close, let's take a moment to reflect on the journey we've embarked on today. We've delved deep into the world of corporate credit, exploring its nuances, its impact on business growth, and the strategies for managing it effectively. We've also cast our eyes to the future, considering the trends and changes that are shaping this vital financial arena. Corporate credit is more than just a number or a score. It's a reflection of your business's financial health and a critical tool in your strategic arsenal. Whether you're a startup laying the foundations of your credit profile or an established business looking to leverage credit for growth and expansion, the principles we've discussed today are universal. Remember, building and maintaining strong corporate credit requires diligence, strategic planning, and a proactive approach to financial management. It's about understanding the options available to you, making informed decisions, and adapting to the changes of the financial landscape. We've heard inspiring stories of businesses that have used corporate credit to transform their operations, expand their reach, and achieve new heights of success. These stories are a testament to the power of corporate credit as a catalyst for business growth. As you navigate the complex world of business finance, I encourage you to keep these insights in mind. Use them to guide your decisions, shape your strategies, and propel your business forward. Thank you for joining me, Jason Feimster, on this episode of AltFinance, the funding frontier. I look forward to continuing our journey together, exploring the fascinating world of alternative financing and uncovering the tools and knowledge you need to succeed in today's dynamic business environment. Stay tuned for our next episode where we'll dive into another key aspect of business finance. Until then, keep striving, keep innovating, and keep growing.